September 2008. A bank that had survived wars, depressions, and centuries collapsed in one weekend. People woke up. Their retirement money was gone. Their jobs were gone. Their homes were next. And here's the scary part. It didn't start with a complex formula. It didn't start with evil geniuses. It started with one simple idea. Why rent when you can own? Sounds harmless, right? Let's rewind. Early 2000s, America just survived two big shocks, the dot-com crash and 9/11. The economy was shaky. People were scared to spend, so the Federal Reserve stepped in. They did one thing. They made interest rates very low. Translation: borrowing money became cheap, very cheap. Imagine money is water. Suddenly, every tap is fully open. And when money is cheap, people start buying things they normally wouldn't, like houses. Owning a home wasn't just practical, it was emotional. It meant stability, respect. I made it. Ads were everywhere. Banks, billboards, TV. Same message. Why rent when you can own? And banks agreed. Actually, they agreed too much. Normally, banks are careful. They ask, how much do you earn? Do you have savings? Can you pay this back? But this time, rules changed. New loans appeared. Adjustable rates, zero down payments, loans with barely any checks. Some had a nickname, ninja loans. No income, no job, no assets. And somehow, people still got approved. House prices started rising fast. Your house gained value without doing anything. People noticed, and they thought, why work harder when my house makes money for me? So they bought more houses. To flip them, to sell quickly, to profit. It was musical chairs, but with houses. As long as music plays, no one worries. Here's the problem. Many borrowers couldn't actually afford their homes. They depended on rising prices, easy refinancing. If prices stopped going up, everything breaks. But Wall Street had an idea, a clever one. Banks took thousands of mortgages, good ones, bad ones, terrible ones. They mixed them together, packaged them, and sold them as investments called mortgage-backed securities, like putting spoiled fruit under fresh fruit and selling the basket as premium. But who decides if it's safe? Rating agencies stepped in. They labeled many of these investments as AAA, the safest rating. Here's the catch. Banks paid the agencies, so the people judging risk were paid by the sellers. What could possibly go wrong? Some investors noticed the cracks. They read the fine print and asked a dangerous question. What if people stop paying? They wanted to bet against the system. So Wall Street created a new product, credit default swaps. Basically, insurance on failure. You didn't even need to own the house. You could just bet it would collapse, like buying fire insurance on someone else's house. And then waiting. 2007, payments start getting missed. Foreclosures increase. Homes sit empty. Prices stop rising. Then they fall. That was never supposed to happen. Once prices fell, borrowers couldn't refinance. Defaults exploded. Those safe investments, they weren't safe at all. Banks tried to sell them. No buyers. Values crashed. Balance sheets collapsed. And then came the moment that shocked the world. September 2008. Lehman Brothers filed for bankruptcy. 158 years old. Gone. No rescue, no safety net. The message was clear. If they can fall, anyone can. Banks stopped trusting each other. Lending froze. Businesses couldn't borrow. Payrolls failed. People lost jobs. Retirement accounts shrank overnight. This wasn't just Wall Street. This was everyone. And it spread globally. Europe, Asia, Iceland. The world economy was choking. Governments stepped in. They had two options: let everything collapse or intervene. They chose intervention. Trillions in support. Bank rescues. Emergency loans. Interest rates near zero. The goal? Stop the bleeding. Using duct tape to hold together a breaking dam. It worked. Barely. The system survived, but something was lost. Trust. People learned a hard lesson. When the system wins, profits are private. When it fails, losses are shared. The 2008 crisis wasn't just about money. It was about incentives, short-term thinking, and what happens when risk is ignored. Because the next crisis won't look like this one. It will look safe, normal, even smart, until it isn't. If this helped you understand the world a little better, like the video. Subscribe for more stories that explain how money, power, and systems really work. And comment below, what do you think caused the crisis? Greed, ignorance, or the system itself?